Everybody, and welcome to our 12th coronavirus webinar. It's been 2 weeks since our last webinar, so clearly the complete focus of this morning is around the reopening phase, post lockdown, and very much focusing in on around the trading activity, what's been going on in terms of vehicle sales, used, valuations. Also levels of employees that have been returning to the trade, and OEM perspective and future potential stimulus. That's really kind of gist of what we're covering today, but there's a lot more to cover as well since we've had 2 weeks out. So it's an absolutely packed agenda, so apologies if we run over. But once again, there will be a recording at the end of today of all the content on the webinar and an executive summary shared tomorrow. So there's a way of capturing things that way as well. So in the interest of time, I shall now pass straight over to Jon Pollock to give us an update in terms of the post-lockdown trading period.
Thank you very much, Steve, and good morning, everybody. Most really of this session this morning, I'm going to talk about the potential stimulus required for the new car market, because I think that's going to be the biggest focus for all of us over the coming weeks and months, and particularly for OEMs clearly at the moment. And there's a lot of activity, as we'll have seen, and we'll go through this morning on a European level. So worth, I think, spending a bit of time on that this morning. And really following the first week of return to trading, I think it'd be fair to say that the general levels of after sales, used car sales activity have been positive. And really it's the new car sales arena that has perhaps been that bit less consistent. And of course, I guess distorted a little bit in this first week of return by, of course, March deliveries that have extended through the lockdown period. That being said, feedback generally does appear to be very positive around online activity and inquiry levels, and they do seem to have increased fairly significantly from obviously the tail end of the lockdown. So that's certainly a positive indication. And of course, a lot of OEMs are now coming back out with their campaigns, leading up, of course, to what's going to be a very, very critical new car market in September. And of course, consequently, why again new car market stimulus is potentially required to get Q3 and that crucial September market back on track. According to JATO Dynamics, the European new car market should look probably more like a U-shaped recovery post COVID-19, whereas, as you know from the various different week reviews we've done on the Chinese market, that appears to be a lot closer to a V-shaped recovery, and that in fact is continuing. Despite a bit of a wobble during April, that's come back on stream at the end of April and during May. And some commentators in the market are actually talking about what they regard as an OEM resurgence. Obviously very electrification orientated, but nonetheless a significant increase as people move away from public transport in China. But in Europe, you may recall I mentioned before that the ICDP, so the International Car Distribution Programme, have said that they've been recommending since the start of lockdown a CO2 emissions reducing scrappage scheme, and that this was needed effectively to avoid obviously the kind of perfect storm that we're experiencing of stalled sales, which we are currently experiencing, and of course the potential of significant stringent fines in line with the EU regulations as they came out at the end of last year. They were talking very much about the kind of need for an OEM-backed, more kind of credit-based scheme, which could help to close the gap between the potential fines and obviously the revenues that have been lost during the lockdown period. However, they did stress from the early stages very strongly that without intervention in the new car market, a recovery is likely to be not only very protracted, but a much higher level of business failure would be seen, particularly in the retailer networks and obviously potentially for manufacturers as well. And indeed, if we look at some of the government loans that have been agreed for the likes of Renault, etc., then I guess that's kind of borne out by that requirement. Now, what is, I guess, a little bit positive, but is also relational to this support for new car market stimulus is how EVs have been performing even during the lockdown period, and we continue to see growth. through March and April across Europe, registrations were up nearly 150,000 units for electric vehicles, and that's during the effectively multiple market lockdown periods, and that's a 17.4% market share across that period. So now we know that Tesla will, of course, have very much influenced that with their Model 3 launch, but nonetheless, significant growth in EV sales during that period for Volkswagen, Mercedes, BMW, and for Volvo. And if we look at pure EVs and plug-in hybrids across Europe during that period, they were real vehicles that drove the growth. Hybrids themselves were actually back some 11%. Now, according to Automotive Management Online, 4 industry associations representing Europe's automotive sector have effectively joined forces to call for a car scrappage scheme as part of the COVID-19 recovery plan. And following publication of SMMT data, the UK, as you may have known, experienced just over a 97% decline in new car registrations last month. The 4 bodies, who are the ACEA, the CECRA, the CLEPA, and the ETRMA, there's a quiz afterwards, have revealed their plan to ensure a very strong restart. So basically this took the form of an open letter to the European Commission and Parliament and also to the UK government. Now, those 4 associations represent the full automotive supply chain, from equipment and tyre suppliers, obviously, to car manufacturers, dealers and workshops. And they want effectively a policy that balances public health requirements, clearly minimal impact to the economy wherever possible, and of course maintains, if possible, a key focus on the objectives around digitization and of course the strive towards a carbon neutral approach to society. So a combined all-round action plan designed to sort of support the new vehicle markets whilst keeping a close eye on maintaining core objectives around emissions legislation. So according to the plan, purchase and investment incentives should be based on similar criteria across Europe, and that's interesting. And this draws on both national and EU funding as well. So the creation of this 25-point action plan follows the National Franchise Dealers Association's view that it is now vital that government and car manufacturers look to deliver a support package that stimulates the market at the earliest opportunity. And data published by PA Consulting in January stated that the top 13 car manufacturer brands faced potential emissions fines totaling just over 14 billion euros in 2021. So obviously, whatever happens around a scrappage scheme has to reflect that requirement and to try to alleviate the imposition of that 95 euro fine potential that clearly still exists from a pan-European perspective. Okay, consequently, a government-backed new car scrappage scheme, it's easy for me to say, could be launched to support the automotive retail sector with incentives of up to £6,000 to switch into an electric vehicle. And some of you may have seen this reported in the Telegraph on the 7th of June. The Prime Minister set out plans then for a speech to be potentially delivered in July, early July, probably around about the 6th, to go through the details of what this scheme could look like. They reported that the scheme would be part of a strategy aimed at relaunching the overall economy. So this is in line perhaps with not what is now not an interim budget, but obviously a statement, an economic statement that is planned as well. Now, I touched on earlier the fact that there should be some commonality of approach across Europe, and that was being sought. And this is very relevant, and the indications actually could create some problems for us here in the UK, because if you look at Germany, the German Chancellor followed effectively the lead of France in increasing their grant for EV buyers in a stimulus package worth about 130 billion euros to boost their economy as well. So that effectively was delivered via a grant of 6,000 euros for pure EV, in addition to an OEM-backed subsidy of 3,000 euros. So this is in line with obviously their existing taxation requirements, where they're looking at increasing and delivering higher tax levels for ICE vehicles and lower tax levels for EVs and low emission vehicles, but potentially up to €9,000 of joint incentive available. And of course, the big issue, if you like, from the German manufacturers, OEMs perspective, is that ICE cars are not eligible. And this is what brings about, I think, potentially the concern for the UK scrappage scheme. The French scheme, just for reference, is around about €7,000 support. So again, quite significant, but also obviously purely on EV. So those two major European market movements will put pressure, obviously, on the UK government to deliver the right level of stimulus for the new car sector. So the scrappage scheme discussed by the SMMT previously has suggested a £2,500 contribution from taxpayers for up to about 600,000 new vehicles, which will be significantly more than those that were processed under the original scrappage scheme. And that would account for around about £1.5 million worth of budget if that could be delivered. The SMMT at the time believed that that would deliver a financial return for the UK economy of about 3 to 1. This, of course, was in the early stages of lockdown. Just as a reminder, the government's first new car scrappage scheme was launched in 2009, following the crisis in 2008, cost the taxpayer around about £400 million, and matched £1,000 in funding from the government with £1,000 of funding from the OEM. Now, of course, what that led to was higher sales rate amongst A and B segment cars, which of course is problematic in terms of the contribution that they make for manufacturers and also for retailers. And of course, the fact that if you look at the manufacturing mix in the UK, then not that many A and B segment cars are actually made in the UK. So the SMMT and the view of the industry generally in the UK is that ideally a UK scheme would support all brands and UK manufacturing and therefore support employment, and would therefore need to include ICE cars, not just EVs in the mix. So either way, some sort of support is looking more and more likely all the time. The lobbying remains in place and grows in momentum all the time. The big issue would be around which types of cars and whether we can get coverage in the UK to support, obviously, all brands. Okay, that's the update on the scrappage scheme, Steve, and I'll hand back to you.
That's great. Thank you, John. Comprehensive as always. We're going to now move to Rupert Pontin from Cazana to give us an update in terms of valuations. So, Rupert, I think you're going to share your screen and slides.
Yeah, hi, Steve. Thank you very much indeed. Have the slides appeared?
I have.
Perfect. That's good. All working well. Okay, thank you very much for giving me the chance just to give you an update today. I'm going to be fairly focused on looking at the movement that has happened with retail pricing from last week through to compared against the previous week. So quite focused. We've also got some new statistics that came through yesterday, which just show a complete trend on what's been happening in terms of some new listings and sold vehicles since the first week since lockdown has allowed the dealerships to open. So first of all, a few charts just to have a look at what's been going on in the marketplace by fuel type. So the chart you're looking at here is looking at the movement of petrol pricing for the period 2nd of June against the previous period, 26th of May. This chart shows that there was a market movement on average for petrol vehicles of a drop of 0.92%. Now, that's the first time we've seen a drop for a couple of weeks. Generally speaking, I'm not overly concerned about what we see here because the chart shows very clearly that there is a significant drop around luxury vehicles of 3.84%. That's the F sector there. So that's just one sector which has dragged down the entire market view for petrol vehicles. Other than that, there have been some fairly steady moves across there. That downward movement reflects about £1,895 per car in that luxury sector, but that is quite a small segment. The one thing that is missing from this chart here is this S, sports sector. If I don't mention it, someone will pull me up on it because that's usually there. Now, we've seen quite an interesting change in the type of adverts within that sector. And we're doing some more analysis around it, but essentially what has happened there, because of the type of vehicles that have been put into the marketplace, we've actually seen quite a significant drop in value of retail pricing there, but I think it's an unfair reflection of what's actually happening with the market. In fact, pricing for the S sector has dropped by 16%. 1 week against 1 week, but you say again, we're doing more analysis on that, and I think this is because of some an increase in the volume of lower price vehicles advertised. So that's excluded from this. So we have that market move for petrol vehicles at 0.92% downwards. The next chart here looks at what's been going on in the diesel marketplace. Slightly disappointing to see that there's been a downward movement. Overall, particularly exacerbated in the executive sector at 0.63%. This is a change on previous week as well. Although the overall market drop does balance out at 0.2%, there are those specific drops there for the executive sector. But generally speaking, not too worried about this. And I think this is perhaps a reflection of a couple of businesses in the marketplace that have for perhaps financial reasons, drop some of the retail pricing, and I don't think this is a general reflection of what is going on overall. I'm going to have a look here what's going on with petrol hybrid pricing. Now, this is interesting because this starts to tie in with some of the comments that Jon made a few minutes ago, also when we look at battery electric vehicles. So consecutively, again, we're seeing a week-on-week move in prices that actually is quite positive here, particularly in the luxury sector and the sports sector. Given that those are quite small in terms of total retail advertised vehicle volume, those particular areas can be affected by a few high-priced vehicles that come into the marketplace or some changes, so that can sway the data. But the important thing here is looking at the key sectors, which would be the large car, the executive, the medium. So good stability and upward movement across those retail pricing, I think reflecting the demand for those vehicles in the marketplace and, of course, also the supply of vehicles. But I will caveat that with the fact that hybrid vehicles are likely to see an increase in volume, bearing in mind the registrations that we've seen over the past few years and the general shift in that direction. So perhaps an area that is very sensitive and needs to be watched very, very carefully with real-time data rather than relying sort of on a monthly view of what's going on, because the nuances in the marketplace can mean that profit opportunity can shift quite quickly. Moving now to battery electric vehicle, and you can see here that this market sector has been significantly enhanced, I suppose, by the large car sector, where there's been an increase of 6.3% in pricing. Let's just remind ourselves that the volume of data in this marketplace is quite small, and therefore, as I said with the previous slide, when I was referring to diesel vehicles in one particular market sector, influxes in volume and type of vehicle can have a significant effect. And I think that might be the case here where we're looking at the large car. Generally speaking, though, the sector's gone up by 1.59% in pricing terms, and the important piece around here, I think, is looking at the MPV sector and the SUV sector, where those price increases are reflecting some new product coming into the marketplace and feeding back into the used car arena, which is helping with pricing, but it's also helping because there's consumer demand there. And again, tying in with what Jon has said, if we look overall at what is going on in the consumer market and how they're reacting and moving towards less polluting vehicles before we talk about any form of incentivization through scrappage and so forth, which I think is probably an important point for consideration going further forward, I think we are seeing a continued increase in demand for these vehicles, particularly, I think, enhanced by the fact that over the past 10 weeks where we've had so much, little traffic, there has been a negative impact on the amount of pollution, and I think probably the consumer rather likes that. So again, a sector that will see in the mid to long term perhaps some reduction in pricing because of its current high price against original cost new. Certainly for the market at the moment in the coming weeks, I think we're going to see some good strength in pricing here. So that's what's been happening in terms of pricing by fuel type. Just going to have a look at some new data that we've been looking at, which is the looking at the new market listings and sales data as we see it from the whole marketplace, where we're reviewing retail pricing data. This is important because we haven't been really able to see much insight on this over the past 10, 12 weeks, because of course we've had the lockdown and the drop in sales, and nobody really was advertising new vehicles. So what we're doing here is we've taken a base point at the beginning of March there in week 10, if you look at the axis on the bottom, and this charts what's been happening in terms of percentage change on the number of vehicles that were removed from platforms, advertising platforms, dealers' websites, week on week. And that's shown in orange. Now, as you would imagine, we see quite a significant drop from week 13 to week 14, because that was when we had lockdown, and the drop there week on week for sales was 79%. But rather interestingly, the previous week, i.e. the week just before lockdown, we actually saw quite a significant number of vehicles sold, up 44% on the previous week. We then see some negative movements, as you would imagine, as we go through the lockdown period. And there in week 18, we see a significant jump up in terms of sales. And I think when we're looking at data based on the previous week. So from week 17 to week 18, we see an 80% increase in the number of vehicles removed from advertising platforms. And I think that corresponds with when the online delivery was announced in the marketplace. So there was an immediate reaction and sales started to get moving again. And that is an important thing to consider. Right over towards the right-hand side of the screen, we see for week 22, which was last week, a jump of 109% in sales terms. That's adverts that have been removed from retail advertising from the market, from dealer sites. So quite a significant jump there. So we see quite a pattern. The blue lines, the blue bars, represent new listings. So that's newly advertised vehicles. And again, similar sort of pattern following with what had been going on with sold vehicles. You can see certainly in the last week, there's been a 110% increase week on week. On the previous week in terms of newly advertised vehicles. So this is a really good gauge of what is going on in today's market since lockdown. I'm going to look at it from a slightly different perspective, hopefully, if I can find the right button. This is whole market data. We're looking at new listings and sales week by week, but we're always comparing here back in a percentage terms to that start point in week 10, which is why we can see a negative picture throughout the whole period from week 10 to week 22. Again, sales in orange, new listings in blue. In comparison with week 10 at its lowest point was week 15, where new listings were down 96%. Okay, that's not a surprise because there was a lower volume of sales, as we see 89% lower than they were in week 10. But it also reflects the fact that there was no new replacement used stock being delivered to the dealer. So that runs all the way through, and it's an interesting chart. Take some time to look at the pack. I'm aware I'm taking up quite a bit of time, but this is an important measure of what's going on in the marketplace. As we go further forward from week 22, 3, 4, I expect this chart to almost swap itself. Well, it won't quite swap itself, but it'll get very, very close to where we were in week 10, I hope. So we must watch this very carefully. Two charts very quickly. This is the comparison last week, price percentage movement in the marketplace by fuel type, that's in orange, against 2019. Just to show and give some clarity around the fact that this year's pricing position, despite the period we've been through, is not too different from where it was in 2020, okay? And there we have my usual chart, which just shows a week-on-week movement as a percentage price change for orange being 2020, blue 2019. So we have seen, very strangely, a more stable pricing movement over the course of the year to date. In summary, retail pricing is still moving. There are some nuances within the different market sectors that need to be watched. It's very important to take care of what's happening in certain areas. There has been, in the last week, a couple of dealers, trading outlets that have reduced prices. They have claimed that's because retail pricing has dropped significantly. As you can see, that's clearly not the case. That may have happened because of financial difficulties they may have been having. Used car demand is growing off the back of the increase in used car sales, as you would expect, but there is a low volume of used cars in the marketplace. And if you're looking at pricing and accurate data in the marketplace, there's actually a very low volume of wholesale data, but still a very large volume of retail data. Steve, I'm going to stop there. Thank you very much for letting me give an update on what's been going in the market.
Rupert, that was excellent. Thank you very much. A lot of information there, but extremely useful and valuable. So really do appreciate that.
No
in terms of online, let's move over to Ben Green to give us a bit of an update in terms of what we're seeing in e-commerce.
Thanks, Steve. Yeah, so as I've taken before when I've spoken over the last few weeks, months, we always take the 8th of April as sort of the worst baseline post-lockdown. That's when everything really, in terms of digital engagement, hit the floor. We've seen growth ever since then. Since the opening and post the announcement of it, it has gone through the roof, as you know, Jon and Rupert kind of alluded to. We've seen an 840% increase in calls from that lowest point. We've seen 297% increase in web forms and valuations going up 377%. So significant rises, and really that is all across the board. But one of the things looked at this week is, even though we've seen growth since the 8th, it hasn't matched up to the year-on-year figures. We were still well off the pace there. So looking at the year-on-year now, we're beating it. So we're actually above. So vehicles being looked at 43% up, calls are up 17% year-on-year, and web forms in particular, which throughout this period has been the strongest form of communication, is up 142%. And again, I've alluded to this before. I think when people think showrooms aren't necessarily working to full capacity, people are working from home and so on, calls tend not to be the route that customers take, but they feel like somebody will be picking up emails. Now, even though these are significant numbers going up, obviously we do have to caveat it slightly in terms of how much of this is the pent-up demand that we've been talking about, and whether this maintains these levels over the next few months will be something obviously we will be keeping a close eye on. But generally speaking, very positive in terms of digital engagement and how people are working with it. In terms of e-commerce specifically, one of the questions we wanted to look at was the rise in e-commerce activity and transactions throughout the lockdown period has been significant. However, you know, once the dealerships are open, are all those customers going, well, don't need to do that now, I can just walk into the showroom and buy a car? The answer from what we're seeing is no. They are still engaging. So steadily, we're seeing transactions of around 110 a day since the first. So that has remained consistent. It's not quite hit the peak it did at the end of last month, but it's only down by about 5 a day. So what it clearly shows is customers, despite the showrooms reopening, are still willing and are transacting online for cars. I was working with a dealer that put not even a full e-commerce, but a simple reserve online. Customer pays £99, reserves that used car for a period, so they can't sell it to anyone else. They put it online on their site. It was like a tiny little button, and they got one within the first day on a 50 grand Volvo. So customers willing to part for their money online, it is there. However, there are problems that are occurring because of this, you know, massive increase in activity. One, obviously, is the decisions around unfurloughing staff. And again, I've been working with certain dealers. The problem is truly understanding what the demand is and whether they want to risk unfurloughing people to cope with that. At the same time, they're missing opportunities because they don't know exactly what that demand is, because they haven't got the people to look into it. So been working with dealers on that, and the ones I've been working with are unfurloughing staff because the demand really is there. And with any kind of online contact at the moment, as that is going to be the primary form of contact for the foreseeable, and was before this, but certainly now, having the right systems, having the right people in place to be able to handle this, and the speed of response is going to be crucial. So I understand the concerns about unfurloughing people, but really look at your call volumes, your web lead volumes, and look at the type of staff you're going to need to handle those, because not everyone is the right person for the right one. So if you know you're getting more web forms filled in online, and maybe a web form contact is the easiest and quickest way to respond to the customer, followed up by calls, etc. Look at the right people to be able to do that, i.e. can they spell? And can they do it effectively? The other issue that I think, and conscious of time, so just go through this quickly, but it's data protection. And I know Andy will talk about cybersecurity and so on a bit later, but you know, with increased online activity and with the aim, and I think this should be the aim, to get customers to do as much of the process online. And sometimes when we talk about the e-commerce parts, we talk about it in terms of, well, the customer's either got to do it themselves or not at all. Actually, you can remotely talk them through that whole process, maintain that contact through your staff, but get them to use those tools so that if there is a required showroom visit, trying to get it as close to just the collection point of view as anything else, because frankly, you know, it's going to be easier on location, safer for your staff, safer for the customers, protects you from insurance things, to do as much of the process online. What that does mean is that you're going to be storing more credit card information, financial information, personal information of those customers. And that can lead to problems if the systems being used are not right. So really check, you know, the payment gateways that are being used online, how that information is being stored, and particularly over phone calls. It was a problem before, and it's still a problem now, is that within phone calls, there are a lot of customers handing over credit card information, and you really shouldn't be storing that in a voice recording, you know, that can be, frankly, easily accessed by hackers if they should so wish. So, I mean, we're bringing in tools around voice analytics to be able to automatically identify these and remove them from the calls and so on. But it's probably something that not a lot of people are thinking about, because obviously we're focused on the virus, focused on reopening and so on. But the reality is, if this data is there and in 6 months' time there's any kind of breach, it's going to be a big problem. So it is something that needs to be looked at the moment. And we can help with that. As ever, if anyone wants any advice on any e-commerce issues, more than happy to have a call and go through that with Steve. But thanks very much.
Thanks, Ben. And linking in, I think, as Ben did, to unfurloughing of employees, which is absolutely fundamentally important and crucial. So it's now time to hand over to Nigel and Emma to give us a bit of an update on the CJRS, which of course is becoming more and more simple. Over to Nigel.
Thanks, Steve. Yeah, I'm not sure about the simple part. So since the last webinar, as we predicted, obviously lots of changes, lots of announcements. We've seen the headlines, so I just wanted to sort of focus quite quickly on some of the detail. Obviously the big headline that we can't avoid is the scheme is ending completely as of the 31st of October. So no more government support as outlined by Rishi from the end of October, but lots of changes between now and then. There will be more detail provided by the government by the 12th of June, so that means on the 12th of June. But so far what we do know is the scheme will close to any employee who hasn't been furloughed for the minimum 3 weeks, 21 consecutive days by the 30th of June. So provided an employee has been furloughed any time from the 20th of March up until the 30th of June, and at any time during that period they've had their 21 consecutive days, then they will be eligible to be furloughed post the 1st of July. It's not about people having to be furloughed at the 30th of June in order for them to be furloughed after the 1st of July. So that's quite important. Of course, that then does mean that tomorrow is a very important day, because if you haven't previously furloughed somebody, if you don't furlough them by tomorrow, they won't get their 21 days in and they won't qualify, and you won't be able to have the flexibility that the scheme is intended to give you between the 1st of July and the end of October. So really important. From the 1st of July, what we know so far is that the flexibility that the scheme will bring to support sort of part-time furloughing, flexible furloughing, it can apply to any amount of time and any shift patterns. There's a claim obviously based on the normal hours not worked. And for those furlough hours, you need to report and claim for the minimum period. We expect that to be a week. So we expect there to be a requirement when the detail comes out on the 12th of June for you to sit down with employees and agree their furlough, their variation on a week-by-week basis, and kind of stick to that. Now, obviously, we know from what we've seen already from the 1st of June and what commentators have already said today, that there's a lot of uncertainty, and we just kind of don't know from day to day, let alone from week to week at the moment, what our requirements are going to be. But we're going to have to make some decisions and kind of stick to that. And we expect that to kind of be for that week by week basis, because you will be required under the new arrangements to submit that data of the usual hours the employee was expected to work. So that's kind of their contracted hours, but the actual hours that they've worked in a claim period. So there's a lot more sort of record keeping that's going to be required to justify the furlough pay claim that you'll be making in future under the new flexible furlough scheme. Now, nothing at all is changing in relation to the to the amounts up until the end of July, so that's good. But they are saying that in the future they will be checking claims, because the maximum number of employees that you can claim for in any pay period in future. So this is after the new rules come in. So after from July onwards, cannot be higher than the maximum number of employees you've claimed for in any pay period in the past. So obviously the aim is to get people back into work, to support flexibility, but not obviously to have lots more wholesale furloughing. That I can understand from the government's perspective, but could be quite tricky if we do have maybe a second spike and we have some regional lockdowns in place. But we'll have to just see how all of that pans out. So scheme contributions will continue as they are up to the end of July. Good news. But for the current scheme, so the non-flexible element of furlough up to the end of June, those claims will have to all be submitted by the end of July. So at the moment, there's lots of flexibility on when you actually put your claim in. Clearly, not many people hang about. It's always good to put the claim in and get the money as soon as you can. But certainly, they wanted to sort of draw a line under the old furlough scheme up to the end of June, and to get all claims in by the end of July, and then move forward on the new scheme, new flexible scheme that really starts at the 1st of July, even though the amounts are the same for July. And then we see from August, the furlough pays the same, but you can't claim any national insurance or pension. And then obviously from September and October, you'll have your mandatory top up of that 10% or that 20% on the furlough pay. So really important, because the records you're going to need to sort of keep where somebody's on flexible furlough is to ensure that you pay them for the days they work at their current rate of pay. So if there was a sort of pay rise or national minimum wage rise that kicked in from April, you pay them for their days they actually work at their full rate. And for the days they're furloughed, will be at their furloughed rate, which is always going to be the 80%. But in September and October, you'll need to sort of do some mandatory topping up of that. And obviously, that's still going to be based on the previous year. So, whether that's sort of February or the year up to the furlough dates in March. So quite a bit of sort of joint calculations are going to be required. Now, they have come out and acknowledged the fact that clearly, we've had about sort of 20 updates of guidance, so therefore there perhaps will have been some errors that have been made along the way, inadvertently. So if you've made an error, so they've now updated how you can correct that, but to the extent that you've received too much from them. So that will be, if you're putting furlough claims in, then obviously you amend the next claim. There'll be sort of a flag for you to sort of say, yes, I've got a bit of an amendment in here as well as my current period claim. But if you don't put any further claims in, they'll be working on another process for you to pay back any amounts you've overclaimed, and they'll let us know when that's available. No news yet on how we're going to deal with areas where we perhaps haven't claimed enough, because of the change of guidance, etc. So still a bit of a one-way street from the government. and notes out to employees to say, look, if you believe that you're not getting your 80% share, please report that on the fraud hotline. They obviously further statements that Hmrc will not hesitate to take action against those found to be abusing the scheme. And also we have some draft regulations, as I mentioned before, to deal with the most serious of cases where there was out and out fraud, and the penalties that will apply to that, and also sort of transfer of debt to directors and so on and so forth. So a real hard push on people that have abused the scheme in the eyes of Hmrc. Obviously an opportunity if you've just made an innocent error and had too much from them to pay that back. But I think we need to sort of lobby to see how we deal with innocent errors, where you perhaps can claim some more. So we're in quite an uncertain time now. I've spoken to a number of dealers who've been pleasantly surprised, I suppose, at the level of activity, both in new car sales and in the workshop. But they haven't got everybody back off furlough. They're not sure how they're going to get everybody back off furlough, when that's going to be, and indeed, what staffing levels are going to be required in the future. So perhaps some things for dealers to be thinking about now are, how have you managed with unfurloughing people, and have you done the necessary paperwork and notifications to employees? Who do you need to furlough by tomorrow, just to continue to give yourself that flexibility? How you manage flexible furloughing, and in particular, how will you deal with those contractual variations? It's going to be really important to avoid not only claims from Hmrc and complications with the calculation, but also claims from employees and tribunal claims and so on and so forth, because these are variations to contracts. There's a tax element, there's a funding element, but there's a legal element we can't afford to forget. Backed up by accurate time recording, and being maybe having the processes in place that we hadn't normally have in place to make sure we're recording that working time, the furlough time, the unfurlough time, and obviously making sure that those pay calculations are correct. How much will that revised support that you're mandated to put in cost you? We thought about that. Can we budget for that? How is that going to impact on the business? And then ultimately, what are those decisions about, pay and reinstating pay or deferring pay, and obviously redundancies? What are they looking like? That's coming into sort of real focus now as businesses start to sort of scratch their heads, think about what resource they require, what flexibility they can utilise, what it's going to cost. And whether really, we can sort of bring everybody back in the short term, and what that looks like in terms of their remuneration and any kind of redundancy packages. So that's it on CJRS for now. We will obviously give an update as we get them. I'm probably only getting a couple of updates a week now, so it's really slowed down. But the devil's always in the detail. It comes from lots of different places, and sometimes the update is just that there's a Welsh version out there. So that's always kind of quite nice to know. But I'll hand over to Emma now just to kind of touch on some of the legal points. So we make sure we don't fall foul inadvertently of the legalities that could trip us up on furlough, and it could be really costly. Emma.
Brill. Thank you, Nigel. Yeah, like Nigel said, there's been some quite significant changes, but albeit it has slowed down, so that's good. And we are finally now getting this clarity. The difficulty that we had when furlough started and up until a few weeks ago was that there was so much uncertainty, that there's still uncertainty in the economy, but at least we now have this structure to the tapered down scheme. And what that's meaning from my experience is a lot of businesses, a lot of dealerships, a lot of other businesses are starting to think, okay, what does our business need to look like in order to successfully navigate the issues in the economy, the issue with lower sales, the issues with everything else. And regretfully for a lot of businesses, that's going to include reduction in headcount, so redundancy exercises. So I wanted to touch on that a little bit today. But before I kind of go headlong into that, just to wrap up some of the legal stuff in relation to furlough and the tapering down of the scheme. Absolutely right what Nigel says. Of course, that we have to make sure that we've got an agreement with that employee if we're going to be using the flexible furlough scheme. So if we're going to be getting them back to work in some capacity, paying them for that, and then keeping them on furlough for some of the other time, we need to make sure that we have that agreement there in writing. We will be expecting the additional guidance, which, as Nigel said, will be last thing, because for some reason the government loves to tax people and employment people to work weekends. Yay. And this will all come clear from that. But what we expect is that, yes, you're going to have that agreement in writing. Now, cast your mind back. It's clear that we have to have agreed furlough with the employees in writing already. We should have some kind of agreement that the employee goes on furlough. And I can almost guarantee you that in that furlough agreement, or whatever you call it, with the employee, you'll have a clause or a section or a paragraph or a sentence in there that says you will not do any work whilst you are on furlough. And that's changing clearly. So we need to make sure that we're putting a different agreement, we're amending that furlough agreement, we're communicating with our employees, and we have their agreement to this, not only from a furlough perspective, but from a breach of contract perspective as well. So that's the first action point. Yes, you need to know what you want your flexible furlough to look like, but then you need to not only have it agreed, but have that as a contractual variation with your employee. So it doesn't necessarily mean signed, sealed and delivered. It just means some kind of agreement back from the employee, a return email, a text message, anything will do in the current times, but just some communication from the employee that says, yes, I agree to this further contractual variation. Clearly, as the scheme starts to taper down, there is more of a contribution from employers. And what I'm seeing there is a lot of businesses saying, okay, we were using the sticking plaster of the furlough scheme to pay the full costs of our employees whilst we could. We're delaying the inevitable. Now we're going to have to start to pay towards their costs. So we need to start to look at whether we actually are ever going to be able to get these employees back into work. So what we're seeing a lot of is people turning their minds towards redundancy processes. And I can't urge you enough to have a think about that now, because a redundancy process is not a difficult legal process to go through, but it's easy to mess up. It's easy not to get right, and then you'll get claims from your employees who have been dismissed for redundancy. And that's the last thing that we need. So it's really important that we get that process right. And that is in the mainstay about planning. What changes do you need to make to your business? Because remember, whilst we can't claim redundancy pay back from Hmrc under the scheme, that has to come out of the business's pocket. There is a potential that we can use the furlough pay to contribute towards notice pay. So if you dismiss an employee, if you go through a fair redundancy process, you've got to the end of it, you have to foot the bill for redundancy pay. If you pay in lieu of notice, so you get rid of your employee immediately and you pay in lieu of the notice period, you can't claim that back under the scheme. But if you keep your employees engaged, albeit on furlough, full-time, part-time, whatever, for the notice period, then you can still reclaim the 80% or whatever it's tapered down to from the scheme. So it's worth, if we're going to be making redundancies, you are better to bite the bullet and get it done now, because you're going to get the benefit of a higher contribution from the revenue for any notice periods. Now, I say contribution because there's a really weird piece of employment law that deals with notice periods. So bear with me whilst I explain. What this piece of law says is if you pay statutory notice to your employees, so an employee is entitled to a minimum period of notice, easy peasy, 1 week notice for each completed year of service. So I've been employed 5 years, that's 5 weeks. Up to a maximum of 12 weeks. If you give your employees just that statutory notice, or up to 1 week more than statutory notice, so in my example of 5 years, that's up to 6 weeks notice, you have to pay them full pay for the notice period, even if they're furloughed, even if they're off sick. They're entitled to full pay notice pay. So you can still claim back your 80% or whatever it's tapered down to from the government, but you're going to have to make a top-up payment to ensure that the employee receives the full pay for that notice period. If you're a very generous employer and you give a longer notice period, so more than 1 week, more than statutory notice, fantastic. You can get away with just paying furlough pay for that period if that employee is furloughed. But it's something really worth, it's a bit of a complex point, but just worth bearing in mind when you are going through redundancy processes. So top tips from me would be, make sure your furlough agreements are up to standard for when you're starting to get employees back to work. Have a look at, realistically, if you're going to require a redundancy exercise, and if you are, plan, and plan. But I'm not a control freak at all. But I can't convince you enough that planning in any employment process is super important. But you can have my contact details. Any questions, queries, or anything employment law related, bob me an email, and I'm happy to help. So that's it, unless Nigel's got anything to mop up. Oh, we have got a question. So what's the process for asking furlough team members to take holidays? Holidays and furlough is still this kind of rumbling question that goes on and on and on and on and on and on. You do have a right as an employer to oblige employees to take holidays on a specific date. You have to provide the employee with twice the amount of notice as the amount of holiday you want them to take. So if you want them to take a week's holiday, you have to give them 2 weeks' notice. Can an employee take holiday whilst they're on furlough? Clearly, we don't have any case law on this at the moment, but generally speaking, we think the answer to that is yes. They can take holiday if they elect to take holiday. Can we oblige them to take holiday? We still think the answer to that is yes. There are some thought processes out there that say, in order to take a holiday, the employee has to enjoy rest, relaxation, and leisure time. And my answer to that would be, well, what the hell are you doing if you're furloughed, apart from resting, relaxing, and enjoying leisure time? But where that is just something to be careful of is if you have an employee who's in that very vulnerable employee category. So somebody who's had the letter from the NHS and has to completely shield from everybody almost. It's arguable that those guys can't make use of their holiday properly. So we just need to be careful with them. But for every other category of employee, we think, yes, we can oblige them to take holidays at a certain time. And the process to do that, all you have to do is write to employees and notify them, giving them twice the amount of notice as the amount of holiday you want them to take. But just on a practical viewpoint on that, where you're likely to get a better morale and better uptake of that, unless it peed off employees, is if you do it in a bit of a softer way. So the way I've been advising employers to do it is to go and say, we need you to take 50% of your holiday by the end of August. And if you don't, we reserve the right to oblige you to take holidays. And it just gives employees that sense of control, that sense of being the master of their own destiny, and that's getting a much better uptake. So I'd try that first, and if that doesn't work, if you need them to take holiday, give them twice the amount of notice as the amount of holiday you want them to take. There you go, sorted. So that's it from me, unless there's anything else from Nigel.
No, that's brilliant. Thanks, Emma.
Fab, over to you, Steve.
Brilliant, thank you, Nigel and Emma. Very useful, because it is so complicated and it's so important. So it's great that you went into so much detail. We're going to be overrunning on this webinar. It's probably 20-25 minutes. So but there will be a recording and an exec summary for people that need to move on. But we'll carry on. And next, I'm going to move to Glyn, who hopefully has got some good news on VAT.
Yeah, hi Steve. I just want to reflect on the end of the VAT deferral, which is coming up. So no new announcements on deferral for later periods, not expecting any. But some good news. For those of you who didn't take up the deferral, perhaps because you didn't think you needed it or you forgot to cancel your direct debits. Hmrc have confirmed that you can retrospectively claim deferral for the VAT return you already paid. That's the March, April, or May one. The February, March, or April one. So you can submit a direct debit indemnity claim to your bank, asking for a refund under the direct debit indemnity scheme. Alternatively, you can approach Hmrc and just say, well, look, I forgot to cancel my direct debit. I meant to defer. Please, can I get a refund of that VAT? So that's something that some of you might use. There's bound to be somebody out there who didn't take the deferral and now think they've made a mistake. Going forward, in the absence of deferral, time to pay is going to be an issue. Now, I just want to give you an idea of the sort of cost to the government of what Hmrc has done so far. So, estimate that the UK has spent something like 8.5% of its GDP towards fighting COVID crisis. Now, to put that into context, only Singapore and Japan have spent more comparative to the size of their economy. So it's a huge commitment by the UK government. And one alarming stat that I read, in April 2020, Hmrc actually paid out more VAT than they collected. So they paid out £897 million, whereas ordinarily, April 19, for example, they collected £13 billion. So that's the scale of the sort of crisis. And that £13 billion, that's just for 1 month. Of course, some of that will be collected in a year's time. I suspect quite a bit of it won't. So that's going to tie the government's hands. And when Jon was talking about scrappage earlier, for example, the government's going to have demands from all different economic sectors. Now, motor is a highly significant one. And the role of lobbying to keep that sector afloat and to give that sector incentivised is vital. So whatever you can do, whatever contacts you have, even if it's just your local MP, lobby, because if we don't, we won't get that support. There just isn't a magic money tree that the government can keep on spending. So in the absence of VAT deferral, time to pay is going to be a thing. Don't expect revenue customers to just accept your requests instantly. In fact, don't expect revenue customers to be nice long term. They've gone through 2 or 3 months of being quite pleasant. It's not their norm. For example, we've seen that Hmrc VAT inquiries are now recommencing after a brief hiatus. So if you're going to approach revenue customers for time to pay, have all your ducks in a row, a bit like loan applications, which Greg has spoken about in the past. Revenue customers will look for cash flow predictions. They'll want to know how long you want to defer for. They'll bear in mind that you already owe them quite a lot of money. So all those things will need to take into account, and we can help with that if you need to seek time to pay on your next return. A couple of quick ideas in terms of cash flow savings outside of that. One is if you're a large taxpayer making payments on account, you need to consider whether your payment on accounts are too high. So your monthly payments will be based on last year's data. This year looks very different, so perhaps you should be applying for reduced payments on account. Again, we can help with that. And then just some basics. I mean, if you're not claiming back all the VAT you can on purchase invoices because you wait until they're posted, well, for goodness sake, let's set up an accrual. Let's reserve for that VAT. If you've got bad debts, don't forget you can claim bad debt relief 6 months after the due date for payment. On the other side of the coin, just a reminder that in April, and this is relevant, I think, to the crisis, in March 19, revenue customers changed the rules on cancellation charges. So if you take a deposit from a customer who is now cancelled and you keep their deposit as a cancellation charge, VAT is still due. So in the past, before March 19, it may well be you just reverse that VAT out on the basis you never supplied the car. Since March 19, that VAT is still due. So I just thought I'd mention that because it's probably relevant to quite a lot of sales. That was it from me, Steve.
That's great. Thank you, Clint. Some useful pointers there. And yeah, I guess a seamless link into Greg on an update on the crisis funding, please, Greg.
Thanks, Steve. Hi, everybody. Graveyard slot today. So moving forward then, just have a look at where we are just quickly on this funding. We'll just do it very quickly. We'll ignore BBLS today. just for time issues. So right up-to-date numbers on the coronavirus business interruption loan scheme as of the 7th, close of business on the 7th of June, £9.65 billion worth of loans, number of facilities approved, 47,650, but from 93,305 applications. So again, they're turning plenty down. And on the coronavirus large business loan interruption scheme as of the 7th of June, now £1.57 billion worth of loans approved. That's 244 facilities approved and 615 total applications. Of course, there will be some applications in there that are still within the system. I really wanted to touch on the larger business scheme just quickly. I was going to do something on CBILS, but for time we won't. We'll just concentrate on this larger scheme. So obviously, since the last time I was here doing this update for you, there's been a change to the larger scheme whereby the loan size for businesses turning over more than 250 million can now borrow up to 200 million. That ceiling of 200 million is, of course, up to a maximum of 25% of turnover. So you have to have the turnover to get the increased facilities. But to do that, the government have said that they have brought in a number of restrictions around being able to take dividends, being able to share buybacks and bonuses and all kinds of other bits and pieces around those things. Happy to go through that if anybody. I've had a number of questions from clients where banks are also putting their own spin and interpretation around that. The Hmrc Treasury statement is that companies borrowing more than 50 million through CL bills will be subject to restrictions on dividend payments, senior pay and share buybacks during the period of the loan, including a ban on dividend payments and cash bonuses, except where they were previously agreed. These restrictions also apply to CCFF, which very few businesses use. This will ensure that the money is used to keep the company going through the crisis. Borrowers cannot make any dividend payments. The borrower needs to agree any share buybacks, and with regard to executive pay, borrowers cannot pay any cash bonuses or reward any pay rises to senior management, including the board, except where they were declared before the CL bills loan was taken out. So again, that is causing a number of different issues. I think in terms of the scheme, again, it's slow still. We are seeing, and I am expecting to see in the government statement just coming up, which was going to be a budget, but is now just going to be a moment, I think they're calling it, that there will be some more support and these schemes extended as we go into the second phase of this recovery, simply because we're still going to need some more working capital. And I think a lot of the banks have been on calls with NatWest and HSBC today already, and they are expecting another wave of applications. So remember, if you haven't applied for either the CL bills or the C-bill scheme, you can still do so. If you have, and the reason the banks are expecting a second wave is because people were asked to put a magic number down of what they needed, and clearly that may not be sufficient. You might need some more cash. So you can come back and get a top up from your C-bills or your CL bills loan. You can top those up. You can get that from a separate funder. So you don't have to go to your bank. You can go to a different funder, but your bank and the British Business Bank will have to sign that off, because clearly what we don't want is people going out and grabbing 50 million here, 50 million there and 50 million somewhere else and overcapitalising themselves and overburdening themselves and therefore causing further issues down the line with taxpayers' cash. So again, happy to talk to anybody around those particular schemes, and if you need some advice about what you can or cannot do, then I'm happy to help.
That's great, thank you, Greg. And as Greg said, I think with the increased working capital pressures now, with the post-lockdown return to trade, then we're working with a number more and more of our clients in terms of their forecasting and the ability to obtain those loans. So thank you for that, Greg. In terms of property, Bill, could you give us a bit of an update in terms of interaction with landlords, maybe?
Yeah, sure. I guess I probably sound a little bit like a stuck record, but I think you really must make requests from your landlords for monthly payments. And our experience is that in most cases, landlords are willing to give monthly payments. Quarter day is the 24th of June for those that are affected by that. Many of you may already have had invoices, so now is absolutely the time to respond to those landlords. As far as getting further concessions is concerned, there is sometimes a willingness to agree to a deferral of the next quarter's rent, but that will need to be repaid, as I've said before, almost certainly over a 12-month period. Our experience is that most of the clients that we're working for are willing to proceed just simply with a monthly concession. That helps them with cash flow, and they don't really want to incur further costs down the line. There has been some discussion about more significant changes to leases, such as lease extensions, etc., in return for rental concessions. I have to say I'm not seeing much traction on that. The terms that typically are proposed, certainly by landlords in return, are not generally very attractive to the tenants. Where we are seeing some success for dealers is where they can trade a break, a lease break, perhaps in the next 12 months or even 2 years. And again, perhaps not untypically for that type of arrangement, we're seeing 3-month rent-free periods being given to trade in against breaks. Finally, I'd say the market, like any market, as Rupert was pointing out, relies on evidence. The property market doesn't have much evidence at the moment. There aren't very many transactions, except in the industrial market, where the industrial market is booming as online is growing. And only last week, a £200 million property transaction was concluded of an industrial estate in West London. So the market is a bit patchy. Other markets, such as the retail high street market, which we all see about, is much more detrimentally impacted. Landlords are very concerned about that. And I think with regard to dealerships, they see it is heartening, the reopening last week. They're really taking a view of waiting to see what is going to happen, how things pan out. And to really follow on a comment that Shaun made earlier, I think it's going to be interesting to see, how much of Shaun's foresight overlaps, such as intervention of motor manufacturers and others. So I think landlords are generally sitting back to wait and see whether how quickly this market can get back onto its feet. And I would also say that perhaps like the car market, we've seen a rapid increase in business over the last 7-10 days. It's a very different environment to where we were before. And we're definitely seeing quite a bit of activity. And at the moment, not much in the way of pricing impact, but obviously that remains to be seen as the full effects of consolidation occur. Jon, over to you.
Okay, Bill, really nothing much to add on the property side, but just to look at the deal scenario at the moment, what's going to happen there in terms of consolidation, businesses being sold, business being bought. Obviously, it's really too early, as you're saying, on property to assess the value of businesses and dealerships. If we look at the PLCs and the quoted companies, obviously the share prices are very depressed, but that's been coming for quite some time. There's nothing new there. Nearly all the PLCs, probably all the PLCs, are trading at well below their net asset value. So in other words, the problems with the sector, even pre-COVID-19, have been factored in to the prices. And really there is a disconnect there in terms of the market capitalization of the big groups and their real value. They're not really connected at all. In terms of the lockdown period, there's only been one, at most two deals that were carried out or completed during that period. One I was involved in was the sale of a Glyn Hopkin Honda dealership in Romford to Paul Brayley. Nothing untoward happened there. That deal was obviously ongoing, but there was no adjustments made because of COVID-19, and that went ahead as expected. So nothing unusual there, or no changed terms because of the pandemic. In terms of looking ahead, the consolidation Shaun mentioned earlier on, consolidation's been going on now for a long time. I think in the last 30 years we've seen the number of franchise car dealerships halved from around 9,000 to 4,500. So that might accelerate a bit, but it is a trend that's been there for a long time. How much that accelerates, we've yet to see. But in terms of operators that are vulnerable, it might not be who people think. It could well be that we will see businesses that started up in operation, franchise dealers that started up in the last 10 years, in many cases very good operators, very capable operators, but with thin balance sheets that have not had the ability to build up in terms of net worth. And that crosses quite a number of franchises. They are probably going to be the most vulnerable group going forward in terms of needing either support from manufacturers or indeed possibly needing to move on their businesses. We're also likely to see, and this again happened pre the pandemic, groups reassessing their core franchises. There's likely to be a number of dealerships that will not reopen. The big groups just taking a view that these businesses were loss-making anyway, they're not viable. So I think that is something that we will see. There will be a small number of businesses that just simply won't reopen. And there will be groups assessing which franchises they want to grow with and which franchises they want to dispose of. Again, pre the pandemic, we were already seeing signs of that with, let's say, VW, with the number one or two of the big groups exiting VW, but one or two other groups wanting to obviously increase significantly the number of VW dealerships they've had. And I think we're going to see that will accelerate on a franchise-by-franchise basis. Really, that's all I've got to say. Martin, do you want to add some things to that?
Yep. Thank you, John. Good morning, everybody. Interesting to just hear John's take on the Glyn Hopkins deal there, and particularly in terms of the prices not particularly being affected by COVID-19. The other deal that was actually also reported in the press in the last couple of weeks was Richmond Motor Group acquiring Newman Suzuki in Southampton. That actually was only recently reported, but did actually happen at the end of March. And those are the only two acquisitions that have happened since lockdown. But I think it's still a positive sign that at the end of the day, life will go on. Equally, on a positive note, Virtue have reaffirmed their interest in acquisitions. They're obviously a very well-managed group, strong balance sheet, and certainly as a purchaser, very good to deal with. But like all purchasers, they have a very selective acquisition criteria in terms of both franchise and location. At the other end of the spectrum, you've got Lookers shares being suspended. They've announced an additional 12 closures on top of the 15 that already announced, and 1,500 redundancies. So having been one of the groups that very much led the market over the last few years in terms of acquisitions, they're not going to be around for a while. Interesting point that John made regarding valuation and the PLC shares not being a true reflection of value, which I certainly agree with. Valuation's always subjective at the best of times, but more so than ever now. And when you're doing valuations, which sadly I've been doing for a very long time, probably nearly 30 years, but you have to take all the factors into account. First of all, the franchise is a key factor. The potential purchasers always have different views, and Volkswagen being a very good example, where some groups have been getting out, like Sytner, Jardines, Inchcape, and others like Virtue and Marshall have been expanding. You also get the fact that all manufacturers have different approaches to those wanting to sell. So again, that's something you've got to take into account. The other factors, property is obviously a key one, meeting current standards, or whether property meets current standards, additional expenditure that may be required. And then I always look at the sort of longevity of a dealership in terms of, there are some dealerships where you can take a view that they're probably not going to be around in a few years' time, either because of location or perhaps size or used car display, etc. Locations, of course, is important. Access, visibility, proximity to other dealerships, the territory that the dealership covers in terms of the size and nature of the market. And then, of course, profitability. Well, there's not going to be a lot of that just at the moment, so reference has got to be made to past profits. And of course, the most important factor is potential profitability going forward. And then the final point in terms of valuation, you've got to look at the potential purchasers. Well, there's plenty in the market in general, but they're not all, they all have, as we discussed before, with virtue of very specific and different acquisition criteria. So that plays a part in valuation. I think realistically, over the next few months, we're going to see a fairly quiet market. But I think as we move towards the end of the year and hopefully getting the Brexit trade deal sorted out, I think for the first time, we're going to have a degree of clarity that we haven't seen for some time. So the groups at the moment are obviously focused on operational issues, but strategy is going to come to the fore. And it's that strategy that will actually drive the market in terms of mergers and acquisitions. Shaun touched on a few of the points, and Jon, in terms of what's going on, dealers focusing on key manufacturer relationships, manufacturers trimming down networks, reducing numbers of partners. And manufacturers have always been a key part of the acquisition process, and that's likely to increase. Consolidation obviously going to continue, and then we're going to see some distressed businesses which sadly may fall by the wayside. So what does all that mean in terms of value? Well, I think it probably means that we're going to get quite a wide variation. This distressed sales in some cases will be at low values, but not necessarily always the case if the sale is managed correctly. And then, as I said before, strategy is going to be the factor that will drive the market. And I think for quality businesses, we're probably going to see, particularly where there's a degree of competition, that there isn't any massive change in prices. And that's what sort of Jon indicated in terms of the Glyn Hopkin and Brayley's deal. So finally, for those looking to sell or those in position looking to sell over the next few months, I think the key to maximising value is first of all to be prepared in terms of establishing all the options, and then secondly, make sure that you lead and keep in control of the sale process. So back to you, Steve.
That's great. Thank you, Martin, and thank you, Jon, and Bill as well. And I think the final point I would make is that, for those looking at your strategic options, then, in Martin, Jon, and Bill, we've got a pretty unique kind of perspective. So by all means, get in contact with us, and we can share our thoughts on your opportunities with you. We're now going to move to something a little bit of a disturbing occurrence, which is going to be covered by Andrea Clayton from Geldards in terms of increased litigation claims during lockdown. So over to you, Andrea.
Hi, thank you. I deal with all elements of automotive litigation at Geldards in Derby. I'm wanting to share some of my clients' experiences following receipt of an alarming amount of county court judgments in the dealerships. What we've found since retailer clients have reopened and returned to work is that they've been inundated with county court judgment orders. Usually they will deal with these claims in the normal process, so responding in 14 days to a rejection or a consumer rights satisfactory quality argument. Normally these are processed 14 days and then you have a chance to file a defence. But during the lockdown period, whilst dealerships have resumed reopening, they've found that a number of CCJs have been entered either incorrectly because they've been served at the dealership address and not at the business's head office, registered office, or there's just been an individual salesman quoted on the paperwork. Unfortunately, that salesman may have been on a furlough scheme. And so for whatever reason, we've found that numerous customers have had a windfall, if you like, in obtaining judgments. This has proved to be really difficult for businesses who are wanting to move forwards and try and positively sell vehicles. They're having to now deal with applications which are made through the court to set aside these judgments. These judgments in themselves are problematic. They cause adverse credit and are there for 6 years and are often ready to be pursued and recovered either by a bailiff or sheriff coming to that dealership, another complete business disruption at this time, or even worse, they find themselves on the receipt of a winding up petition. I don't know how much exposure you've had to dealing with such litigation, but a couple of examples that I'll quickly run through. dealership opened last week. They were aware of a customer complaint. There'd been an exchange of emails post-purchase. That customer was looking to reject the vehicle due to satisfactory quality. Ordinarily, the physical return of the vehicle to the dealership would be a prompt, but in this case, the dealership was not open, so the vehicle remained with the customer. The dealership did not receive any claim form, so the first they were aware of any live proceedings against them was when they found a court order ordering them to pay £10,000 immediately. The dealership hadn't been served with the claim form, so upon taking my advice, they appeared to have a reasonable chance of defending, based on the fact that they'd not been given an opportunity to repair a very minor fault. They'd been served, and had they been served, their intention was to dispute liability at all times. They correctly contacted the court and obtained a copy of that claim form, and it was showing an incorrect address. On that basis, I advised the client that we needed to make a prompt application to set aside. This is done quite swiftly. It can be done online and is on completion of an application order, an N244. The grounds that have to be satisfied are always twofold. One, that the application is made promptly, and prompt is, as determined by case law, is 2 weeks or below. And the second ground is that you must have an arguable defence. If you haven't got an arguable defence, that application will fail. Once the application was put in, together with any supporting evidence, such as a witness statement from the appropriate person or a draft defence if that's possible, then the application is heard by a district judge. Even more complicated at the moment is the fact that judges are dealing with these by remote hearings, so telephone hearings or Skype hearings. We successfully had this application set aside, and the judge did grant permission for a defence to be filed and the case to run as normal. What we've actually been able to do at Geldards is prepare a suite of these documents ready to assist our retailer clients so that these applications can go in very, very quickly. We can take the headache out for having to make these whilst running a business. We've even got to the point now that when our last application was made, and we've done 30 this week alone, our last application was made and the court was satisfied that they would make an order to set aside the judgment on paper. We didn't even need to have a hearing. So the judges have borne in mind the civil procedure rules there, read promptness and an arguable defence, but they've also considered practical effects of COVID, so staff on the government furlough scheme, post being intercepted, and our understanding, which has been obviously a breath of fresh air for the industry and my retail clients. So if you find yourselves on the end of a default judgment, my advice is act immediately. An application, an N244, must go into the county court, supported by evidence, showing what defence you have if possible, and also a requisite court fee of £255 is payable. If you've satisfied those criteria and an application has gone in promptly, that will stay any level of enforcement action being taken against the dealership. As I mentioned, bailiffs or sheriffs coming to the dealership is not desirable, certainly not at the moment. Don't delay. As I say, we have a suite of prepared applications we can help you with. Act quickly, put the application in supported by evidence, and if this is done correctly, you will receive some sympathy and support from the court.
That's brilliant. Thank you very much, Andrea. And yeah, that worrying development, but obviously a lot of help that can be provided there. So thank you. Very quickly now, Lee and Andy Lee's been doing some great work through crisis on business interruption insurance and other insurance. So if you could just give us a brief update, that'd be very, very good. Thank you.
Thanks, Steve. Morning all. Obviously conscious of time here, I wanted to provide an update on the COVID-19 business interruption position and where we're at with regards to our business interruption insurance recovery scheme initiative for motor dealers. Been a lot of discussion lots of recent press coverage regarding business interruption insurance. There's also been a lot of lobbying by numerous groups for government to step in. We've been one of those groups who've been extremely vociferous on the subject, certainly taken up a lot of my time over the last 3 months. We've had recently several discussions with members of the Treasury and reassured that the Chancellor's declaration to do more remains very much open. I'm also pleased to report that the momentum is definitely gathering. On the 1st of May, the Treasury asked the FCA to investigate insurance companies' refusal to accept business interruption claims, following which the FCA instructed insurance brokers, policyholders, insurance companies to submit contentious, ambiguous policy wordings for legal review. They also asked insurers to explain how they were planning to address these claims and why. It's very clear the FCA wants to challenge these wordings through the legal system in the High Court. And I think, as far as I'm concerned, it's an extremely positive move as it continues to raise the awareness of the subject, which we wholeheartedly support. Together with external legal counsel, the FCA identified 40 ambiguous policy wordings provided by 8 different insurance companies, which they've now submitted to the High Court. Unfortunately, none of these are motor trade policy wordings, but that said, some of the wordings, such as the QBE business combined policy wording, are not too different from the QBE's motor trade wording. And so if the FCA is successful, we will be placing huge pressure on those insurers concerned to respond positively for our motor trade clients where applicable, of course. Concerned that many UK businesses may not survive after the withdrawal of the government's job retention scheme, the FCA is seeking to fast-track the legal process with a provisional trial date set for a week commencing 20th of July. They hope to receive judgment by the 1st of August when, before the courts close for the summer break, although my personal view, given the number of wordings and the complexity of the case, I think it's highly unlikely judgment will be received before mid-September or possibly even October. But regardless of that, the process would be significantly faster than normal. Every insurer, as you can imagine, is awaiting the outcome of the High Court ruling, which will undoubtedly have a bearing on their future claims decisions. As a result of our lobbying, I was invited to attend a meeting chaired by Matt Brewis, who's the Director of Insurance at the FCA, together with their legal counsel, which we found extremely encouraging. Again, on the subject of lobbying, many of you will know that we've embarked on our campaign for our Business Insurance Recovery Scheme initiative. Whilst we're still waiting for quite a lot of dealers to return their financial data, we feel extremely positive that we've got some interesting data to support our claims. From what we've had back so far, the analysis shows a clear pattern of gross profit loss, which averages around 32% across the board. It's also clear that smaller franchise dealers, maybe 1 to 5 sites, appear to have suffered greater gross profit losses, averaging 38%, compared to maybe 27% suffered by the larger groups. Interestingly, these numbers differ when it comes to the reduction in their turnover. The estimated overall drop in turnover averages 35%, with the larger group reductions averaging at 37%, compared to 32% for the smaller franchise dealers. Our initiative also looks at job losses, and the data predicts these numbers, with the early indication being 19% across the board. I guess it's no surprise that the larger dealer groups' initial job loss predictions average 24%, whereas the smaller franchise dealers average 15%. I said these were early indications. They were applied during the early stages of lockdown, prior to any of us understanding what reopening looked like, or even when that might even take place. And I guess given all the unknowns, and in line with what Emma said earlier, it's likely these numbers are going to increase. Admittedly, the data only provides a snapshot of the estimated gross profit losses suffered by motor dealers for the current financial period, many of which are likely to continue, in our opinion, into 2021 and possibly 22. However, the data already demonstrates the need for additional financial help from the government. Glyn highlighted the huge pull on government's finances earlier, which will not help our cause, I guess. That said, our position hasn't changed. We believe there's still a profound, urgent need for government to keep businesses afloat for the sake of the nation's future, and particularly of the motor trade sector. Dealers need revenue to service their debts and overheads, and the primary focus of our initiative is to demonstrate the scale of the gross profit losses to government and present a sensible, pragmatic and workable solution to support all motor dealers, regardless of whether they purchase business interruption insurance or not. If you've signed up to our initiative, we would like to, if you haven't signed up for the initiative and you would like some further more details, it's not too late. You can still do so. So please feel free to contact me. When we began this process, we were uncomfortable and unimpressed with the insurance industry's overall response to COVID-19 business interruption claims. And we wanted to do something, do as much as we could to help our clients remain in business, to help us remain in business. And we fully support the FCA's legal test case to insurers, to which we've, by the way, submitted numerous policy wordings. And we remain committed to lobbying government to seek additional support for motor dealers. I shall, of course, keep you all updated with regards to our progress, but if anyone has any questions in the meantime, feel free to contact me. Thank you, Steve.
That's great. Thank you, Lynn. Sorry, I kind of rushed you there. There's some great stuff in there, which we'll make sure is covered in the executive summary. And finally, Andy Flynn, brief update, GDPR, cyber.
Hi, hello there, and good afternoon, everybody. Just a quick one to give you the latest. As we suspected, on the switch back on, and people going back to work, there has been increased activity, both in cyber and GDPR-style requests, probably highlighted by Kent PPE firm that was hit with an 800k ransom on Bitcoin, a company that is owned by Kent County Council. The anonymous hackers are back, based in the States, doing DDoS attacks, which are basically flooding the servers with data until they stop working. This generally has been infiltrated by the fact there's been some data leaked from police data systems, which has sponsored this, and is why they are particularly focused in that area. As a result of this, the suspicious email reporting service, SIRS, is there and recommended to be reported to the National Cybersecurity Centre, report@phishing.gov.uk, of which 614,000 suspicious emails have now been reported. Just over 1,200 have been removed as scams, and on over 4,500 URLs. Cisco and Google have released iOS and iOS X software upgrades. Sort of 47 vulnerabilities at Cisco with 3 critical bugs that were identified. Google with multiple security fixes on their desktop edition of Chrome, and Mozilla have done the same with Firefox. So just to say again, with this back to work, vigilance is the key. And as I expected, cyber and GDPR requests are on the up. So thank you today, Steve. Talk to you later.
That's great. Thank you very much, Andy. I think you've all guessed it was by luck rather than judgment in terms of me achieving the timetable on the other webinars. I tried to pack too much in today, so apologies for that, but I hope it's been useful. I've certainly found it extremely useful. I'd like again to thank all the presenters for the contributions. Thank everyone else for joining in. There will be a recording we will get out by the end of today, and also an executive summary, pretty detailed executive summary, I think, because the breadth of content that we covered. And then we'll look to arrange our next webinar, probably in 2 weeks' time again. Try not to be too optimistic in terms of what I'm looking to cover, but certainly around some of the government stimulus, financial aspects of trade, and maybe a little bit more on electrification and what's happening there as well will be topics. So once again, everyone, thank you for your time, and please take care and stay safe. All the best. Goodbye.